This past week, home loan rates were largely unchanged despite the Fed raising rates to the highest level in 22 years. Let's discuss what happened and look at the week ahead. Yes, another rate hike. On Wednesday, the Federal Reserve raised the federal funds rate to a range of 5.25% to 5.5%, as widely expected. Chairman Powell also shared that if the data comes in strong over the next 2 months, they will raise rates again in September. There will be 2 inflation reports, 2 jobs reports, and 1 employment cost index, which garners most of their attention before they meet again. The underlying economy remains resilient, and this is one of the main reasons interest rates remain high and the Fed has continued to raise rates. Many economists, market watchers, and central bankers were calling for a recession by the middle of this year. In fact, one reputable publication back in November said there was a 100% chance of a recession in 2023. So much for predictions. Unfortunately, or fortunately, depending on how you're looking at it, the economy is currently growing near 2% and unemployment is at 3.6%, which are not conditions that lead to an economic recession. Watching the economic data will be important to determine whether the Fed increases rates further. At the very least, we should be prepared for the Fed to hold the federal funds rate at current levels for quite a bit longer. How much longer, you ask? The Federal Reserve wants to see inflation come down to 2%. The Fed's favorite gauge of inflation is currently running at 4.6%. There is a lot of wood to chop for inflation to get near the Fed's target. In fact, the Fed's forecast calls for core inflation to reach its goal in the year 2025. So when we hear higher for longer, that's what we mean. For reference, in the last rate hike cycle back in 2018, the Fed's cut rates 7 months after the last hike. Meanwhile, during that same time, home loan rates steadily improved. Bottom line, the Federal Reserve may very well be done hiking rates. However, long-term rates may start to edge lower slowly. Why is that? Well, the economy is slowing slowly. Unemployment is rising slowly, and inflation is falling slowly. If this trend continues, Chairman Powell may get his soft landing after all. Looking ahead, this week, we will get one of the Fed's important readings to watch, the jobs report for July, which will be released this coming Friday. Expectations are for 184,000 jobs to be created. This would be the lowest reading since December of 2020. Within this report is hourly earnings, which the Fed watches closely because if people are receiving more pay, it could lead to higher prices and thus more Fed rate hikes. Now, here is a glance at the charts and current mortgage rates. All right, here's the Fannie Mae 5.5% coupon on a 30-year fixed rate. Just a reminder, as bond prices go up, rates go down, and as bond prices go down, rates go up. They have an inverse relationship. Green days are good, red days are bad. We had a nice session on Friday, nice green day there, and we're starting the week off to the better as well. However, we are off some of the best levels that we saw here earlier in the month. Middle of the month, we saw a nice improvement after the CPI report that came in lower than expected. That's translated into interest rates right now that are hovering in the upper 6s to low 7s for conforming 30-year fixed rates, and jumbo 30-year fixed are about the same. FHA and VA are in the lower 6s, and we can pick up a VA 30 years somewhere right around 5 7/8. I appreciate you spending some time with me here today. If there's a scenario or information I can provide, feel free to reach out by email, text, or phone. Feel free to share and like, and enjoy the rest of your week.